If building wealth feels complicated, simplify to a three-fund setup you can automate for years. One broad U.S. stock fund, one broad international stock fund, and one high-quality bond fund, then let time and consistency do the work. This DeWitt-Wantz core is designed to capture entire markets at low cost while minimizing decisions, which supports staying invested long enough for compounding to matter. Start by naming the roles so each sleeve has a clear job that never changes, even when headlines do. Broad US. Stocks are the growth engine. Broad international stocks diversify your economic and currency exposure beyond one country, and core bonds add stability to dampen portfolio swings and provide rebalancing dry powder. Choosing low-cost, widely diversified index funds or ETFs for these sleeves keeps tracking tight to the intended markets, with fewer frictions that erode long-run returns. If index fund versus ETF is confusing, remember they're wrappers for similar exposures, not different strategies. ETFs trade intraday like stocks and may pair well with brokerage automation and fractional shares, while index mutual funds transact once at end-of-day NAV and can be simpler inside many employer plans. Both can track the same market at very low cost. For a three-fund core, either wrapper can work if fees are low, tracking is tight, and your platform supports recurring investments and reinvestment. Define the U.S. stock sleeve as a total market fund that owns large, mid, and small companies in a single, cap-weighted vehicle. This reduces single company risk while naturally reflecting the market's changing leadership over time without you needing to pick winners. Favor funds with long records of close tracking and minimal expenses, since tiny fee differences compound into real spread over decades. Define the international stock sleeve as a total international fund across developed and emerging markets so one position captures global diversification. This broad exposure helps avoid home country bias and can lower the chance that a single economy's slump dictates your entire result. As with U.S. stocks, prioritize low expense ratios and consistent benchmark tracking instead of narrower regional bets as your core. Define the bond sleeve as a broad investment-grade core often called aggregate bonds, so interest rate and credit exposures are diversified rather than concentrated. The purpose here is ballast and liquidity, not chasing yield, which keeps the bond sleeve reliable when stocks wobble. If your time horizon is shorter or volatility tolerance is low, consider shorter road duration bond options for a steadier ride, but keep quality and costs front and center. Now wire the habit that powers this portfolio, set a fixed contribution cadence aligned to payday, and keep buying through all market weather. Dollar cost averaging buys more shares when prices dip and fewer when they rise, converting volatility into scheduled share accumulation while removing the when to buy question entirely. Turn on automatic reinvestment so dividends and interest are immediately put back to work between paychecks, growing the base even in quiet months. Pick the wrapper mix that fits your account so automation is easy instead of fragile. Inside many 401k and Roth 401k plans, index mutual funds are common and pair well with paycheck deferrals and end-row day auto invest, which is perfect for a three-fund lineup if the menu offers each sleeve. In IRAs, Roth IRAs, and taxable brokerage accounts, low-cost ETFs are widely available with zero commission trading, fractional shares on many platforms, and intraday execution for those who prefer limit orders. Keep costs low because they scale every year you hold. Compare expense ratios across similar broad funds or ETFs and favor those with tight tracking to their benchmarks, which you can gauge by looking at multi-year tracking differences. With ETFs, remember that bid-ask spreads are part of total cost. Use simple trading hygiene like limit orders and avoid the very open and close to reduce slippage. Your stock divided by bond mix sets the experience, so anchor it to time horizon and true risk tolerance rather than return hopes. Longer horizons can tolerate higher equity weights because there's more time to recover from drawdowns, while shorter horizons call for more bonds to stabilize the path. A practical test is whether you can sit through a 20-40% equity drawdown without changing the plan. If not, increase bonds until the answer is yes. Build a simple contribution plan you can keep. Set biweekly or monthly transfers into each sleeve. Use fractional shares where available to deploy exact dollars, and escalate contributions annually with raises to let savings grow with income. When dividends and interest show up, reinvest them automatically, so compounding is continuous rather than waiting for you to log in. Rebalance with rules, not feelings. Set tolerance bands around each sleeve, such as plus or minus 5 percentage points of target weight, and rebalance on the earlier of a band breach or a scheduled annual check. Use new contributions to nudge weights back toward target first, then sell only where necessary, which reduces taxes and trading costs in taxable accounts. Place assets thoughtfully across accounts to improve after-tax results without adding complexity. Tax-efficient holdings like broad taxable bond funds often fit best in tax-advantaged accounts, while broad equity index funds or ETFs can live comfortably in taxable accounts thanks to lower turnover and potential tax efficiency. Keep the sleeves recognizable across accounts so you can rebalance simply and see the whole portfolio at a glance. Expect markets to move and pre-commit to how you'll behave. During downturns, the job is to keep the contribution schedule running, consider tax loss harvesting in taxable accounts when appropriate, and let rebalancing move you toward the sleeve that's fallen below its band. During euphoric runs, the job is identical. Keep the cadence, stick to the bands, and avoid improving the plan based on recent news. Here are 3 example allocations you can copy and adjust as life changes. For early wealth building with decades ahead, 80/20 stocks to bonds with 60% U.S. equity, 20% international equity, and 20% bonds is a common starting point. For balanced growth, 60/40 splits the risk more evenly while maintaining global equity exposure and a meaningful bond ballast. Approaching retirement or funding near-term goals, 40/60 prioritizes stability and planned withdrawals without abandoning diversified stock exposure entirely. Set up day one with a short checklist, so this is done in an hour, not a month. Choose your 3 core funds or ETFs, set target weights, enable dividend and interest reinvestment, and schedule contributions aligned to payday. Add calendar reminders for an annual review and alerts for rebalancing bands. Then write down your rules so execution beats improvisation when volatility appears. If your plan lives across multiple accounts, map which sleeve sits where before sending money. Prioritize capturing the full employer match in a 401k, fill tax advantage space in IRAs or Roth IRAs with whichever sleeves best fit, then route any extra to taxable accounts while maintaining total weights. The goal is fewer moving parts and a single dashboard view of your U.S. stock, international stock, and bond sleeves across all accounts. Finish with a promise to your future self. The 3-fund portfolio works because it is broad, low cost, and boring enough to keep through every cycle. Your edge isn't guessing better, it's funding on schedule, reinvesting automatically, and letting time and diversification carry most of the load. The callback is simple compounding plus DCA plus broad index funds or ETFs do their best work together when your rules remove timing from the equation. Next, take 10 minutes to pick your stock divided by bond split with a practical framework tied to time horizon, risk capacity, and real tolerance so your 3-fund plan has the right heartbeat for your goals. Expect simple guardrails, examples across 401k, IRA, and taxable accounts, and a stepwise step you can apply immediately without new tools or guesswork.